Rick Santelli standing by at the CME in Chicago. Rick, give us the numbers when you get them, please.
Absolutely. And let's start out with housing permits for the month of February. 1,769,000. That's seasonally adjusted annualized units. And that really, really is a biggie because that takes us all the way back to 2006 to find a higher number. And, of course, how that breaks down between single-family, multifamily is important. When we look on the permit side, also a whopper of a number, 1,859,000. And, of course, that follows a slightly revised 1,895,000. These numbers all take us back to 2006 in housing, and we know the issues there. There's supply issues. We'll see how interest rates potentially affect maybe bringing on more supply or how that affects pricing as they correlate, of course, with 7 to 10-year treasuries. Now, let's look at what's going on the Philly Fed Index. That's a March read, 27.4. That's almost exactly double what we were expecting, and that's the best number since November of last year. And finally, initial jobless claims. 214,000, and at least right now, 227,000, Joe, from last week remains unrevised, so we'll call it down 13,000. And just to put a face on it, the cycle low here that goes all the way back to the Beatles in the 60s was 188,000. That was in early December. And finally, the last set of report numbers here is continuing claims, a week in arrears, 1,419,000, 1,419,000. That is a new post-COVID cycle low. And indeed, this is very good news. We know that the Fed may think we're getting close to full employment. I have my doubts. I never underestimate how we don't count unemployed people sometimes. Interest rates have moderated, but they're at much loftier levels than they were just a couple of weeks ago as we continue to monitor how close to 2.25 we get in 10s and the big traffic jam between 3s, 5s, 7s, 10s, and all the subtle inversions there, and the fact that 20-year bonds are king of the hill in terms of the highest yields on the Treasury curve. Becky, back to you.
Yeah, demolition derby, all of them playing at this point. Rick, thank you very much. We're going to get more reaction right now from Steve Leisman and Diana Olick. And Steve, you go first.
Can I go after Diana? I'm fascinated to what she thinks. I'm sorry, Becky, to mess up the whole order here.
The gentleman,
but I'm fascinated what Diana thinks about housing. The gentleman cedes to the colleague in D.C.
Mm-hmm.
Okay, Steve, look, here it is. I'm pleasantly surprised for the home builders because I'm going to break this down between single family and multifamily, as I always do. The biggest numbers are in multifamily, but we were concerned about single family because of rising mortgage rates. And what we're seeing is that the home builders are not apparently particularly concerned. And I was watching the permits very closely because that's, of course, an indicator of future construction. And we saw permits down month to month, 0.5%, but not terrible, but up year over year, nicely up 5%. Single-family starts up 12% month to month and only down slightly 1.7% year over year. And this is important because we saw home builder sentiment yesterday. It has three components. And of the three, buyer traffic and current sales were not terrible. It was sales expectations over the next 6 months that dropped a whopping 10%. So we thought the builders were concerned. But then I talked to chairman of Lennar, Stuart Miller. Their earnings came out late yesterday. And he was still very bullish. He said in surveys across all of his home building sites, they were seeing very strong demand from buyers. So this was all when rates were still coming up through February, through March, and we are a full percentage point higher on the 30-year fix than we were a year ago. We touched almost 4.5% yesterday after the Fed reports. So again, buyer demand is still very strong, and it's affordability. We still have high home prices. So again, pleasantly surprised, but we still have a ways to go when we get into the next couple of months and we see how much competition is in the market and how much that pushes home prices up. Lennar did report it was having trouble because of inflation, of course, for all the building materials, et cetera. But again, pretty good numbers. Steve, I cede to you.
Yeah, that's what I wanted to hear. That's what I thought, because you take all three components that came out this morning. Jobless claims down to 214. That's just about pretty much, it's even better than we mostly did before the pandemic. Philly Fed swimming at double the rate that we had before, and now housing. And let's just talk about where we are in the cycle here. Diana just mentioned it. We have 100 basis points extra on the mortgage rate. We have, Rick was talking about it, I don't know, 140, 150 basis points of tightening built in to the 2-year. We also had this shock from the war in Ukraine, of which some of this data is post that. For example, the jobless claims data, even perhaps some of the late month housing data came before it. And the economy seems to be doing just fine. It's kind of echoing to me what Powell said yesterday, that the economy is doing well and can withstand these rate hikes. So I'm gratified to see this, Becky. I don't know if it's, you don't want to say it's a done deal because we did have that somewhat weaker retail number yesterday. We need to look inside consumer spending and see if they're taking money from that they're spending for oil and gas and energy and reducing spending elsewhere. But right now, on those three components, we got manufacturing, housing, and the jobs market. The economy seems to be doing well and even better than expected on all three.
Shepard Smith here. Thanks for watching CNBC on YouTube.